Do you think it's weird that VCs don't try to underwrite lower valuations? Like the incentive is always to up your valuation. Even if the company's performing plan, you don't generally do these like market-driven value. It's like, oh, you were worth 500 million last round, we'll give you $1 billion this round. And are we going to see more VCs do down rounds?
I just think that
in companies that they're in?
There's no VC club where they get together and discuss how they're all going to behave.
Yeah.
But
so you're looking at it.
The price fixing.
But keep in mind, as that risk on goes slowly up and up and up, and especially in Silicon Valley, we've had a systematic shift of power from the investor to the founder over a very long period of time. People are friendly because they want deal flow. So nobody does it. Nobody.
Let's talk about that.
Interesting.
We've seen deals happen where, one term sheet seems great for all shareholders, and then this term sheet includes some secondary for the founders, and no governance seems pretty great for the founders, and somehow this one magically wins, and somebody wins the deal by not taking a board seat. In the 3 decades you've been doing this now, I think it's 3 or 4. Going into the 4th? It might be going into the 4th.
Wow.
I mean, well,
He's in the 4th decade, yes.
He's in the 4th decade.
No.
When you look at governance, what is the mistake we've made over this last bull run?
Well, once again,
what should it be?
what's
the right partnership?
I think what it should be is that the market gets to decide. So if someone can raise, $100 million with no board seat, no rights, and they want that, I think they should be able to do that.
Right, but what's in the best interest of our industry, of all shareholders, the employees, the industry?
I'm not dodging the question. It's just super complicated. We put money behind Rich Barton, and so both of us did, and he had super voting, but he also, I think, is very honorable about his duty to shareholders, and so
there was a track record there.
And it never was an issue in the entire history of the company, and so if there's a first-time founder that's doing that, who knows what the motivation is, and but once again, it's a market, it's a free market, and I think that there are certain people or founders that decide, hey, you bring something to the table that I want, and I understand there's a government's requirement to it, and we'll opt into that. And, willing buyer meets willing seller.
Gurley, what do you guys, Brett, what is your attitude when you guys actually have a win? You do the job, company goes public, and you have the chance to distribute to your LPs. There's been a movement in Silicon Valley where some firms have said, you know what, guys, I'm going to hold this forever. I'm going to create permanent capital structures, evergreen funds. If you foundation want a distribution from me, just tell me and I'll give you money magically somehow, et cetera, et cetera. What do you guys think about that versus just distributing and walking away, booking the win? And if you want to hold the stock, you just hold it in your own private account.
Well, let me just start by saying that investing is really fucking hard. And there's a lot of ways you can lose, And when you guys started the podcast, I was listening to one of the episodes today, and it really hit me. In the song that you put together, David says, "Let your renters ride." And
what?
I remember that. I remember that episode.
So from the brief history of the podcast, you've gone from talking about that as a strategy to this question that you've posed to me, which is on the opposite end.
In my defense.
He's here. He talks. He's appeared.
What? He's awake.
Yes. He's alive. He lives.
We have all these great minds here, so I figured I'd give them a chance to talk. I like some of the people on the pod who like to hear themselves talk a little bit too much.
He was resting his eyes.
All right, now, in fairness, when we had that conversation, as I recall, the context was that way back when, like for example, when I had Facebook and Facebook went public, the urge was just to sell it all. And so I think where we landed on that was don't sell 100%, keep 20%, keep 50%.
No, but that was you personally.
It was schmuck insurance, basically.
Yeah, but that was for you personally as an investment. Right. What about you as a fund manager?
Yeah, I think for me as a fund manager, so I think we did a pretty good job over the last 6 months distributing out some gains, some realizations. We actually paid back our whole first fund. But in our second fund, we had about 120 million of a firm stock, and we were sitting on it because we believe in the company and still do, and we're still sitting on it. And that was like a $100 million mistake. So, so I think, what's my attitude going to be from now on? Honestly, my attitude from now on is probably going to be distribute it.
So my first chance to actually return any real money to our LPs was when Slack did our direct listing. And it was like, there are 3 or 4 of us on the board, me, Andrew Brach at Excel, John O'Farrell from Andreessen, 2 independents, and Stewart. And they had gone through a couple direct listings before, bring in our bankers, and they go through this whole rigmarole. And I remember being so amped up in the whole thing. And I thought, oh, I believe in this company. I believe in all of this, blah, blah, blah. Long story short, the point is, I held the stock. I didn't distribute it. The pandemic hit. I then distributed in sheer panic. And we left a lot of money on the table that I could have just booked the win for the LPs. And then from that point, I said, never again. I'll hold it for myself. But the minute that I get a distribution, if I'm in the business of managing money for other people, it's out the door when it's liquid. And I'm not going to I'll be happy to take a point of view for my own shares. But God, I felt so stupid. I took a 50% loss trying to be a hero.
Well, I mean, and then also we have the issue of selling in secondary when those opportunities arise. And we all just watched the We Crashed documentary, which one of your partners plays a role in. I don't know. Obviously, it's probably 5% reality, but Benchmark did make a pretty amazing trade in selling WeWork shares early and booking an enormous win. Correct, Bill?
Correct.
Okay, so just an alternative.
Wait, what's the answer to the question?
So
What do you do, distribute or not distribute?
Yes, that's what I was going to give you. I was going to actually answer.
Secondary options.
So to me, the most important thing is tell your partners what you're going to do, and then do it, because you're making a deal up front. So for us, the deal was, if we invest in something in our venture fund, and it's realized, it goes public. If we see venture-like returns, which we define, and they with them, as 2 to 3x over a 3-year time horizon, we will hold. If we don't, we distributed. Last year, we distributed over $6 billion, which was more than all the venture we raised in our first 5 funds. Why? Not because I didn't like Unity or I didn't like Snowflake. Everybody knows how we feel about these businesses. But because we realized that according to the deal we had made with our partners, the framework was triggered. And the second thing I would argue is, because people are talking about permanent funds now and all this, that I'm not sure that's the deal people made.
Yeah.
For me, if you're an investor or limited partner in our fund and you want to hold on to it, then also invest in my hedge fund. Because there we haven't sold a share of Snowflake. But that is a different liquidity profile and a different.
But what I was getting to, Bill, and just let's put WeWork on the side. Just in general, when the opportunities for a firm to do a secondary arises, what's the right thing to do?
That's rare. I mean, that's rare for an angel. I think it's very different, but it's rare for a venture firm to meet a secondary that has the firepower to absorb the type. That was Masa. I mean, that was very. Unique situation. We typically distribute over 3 to 6 quarters following the lockup release, unless there's some
Just
exception.
systematically.
Yeah.
Dollar cost average.
Yeah. There have been a few exceptions. We took OpenTable public in 2009 at a very low value, knowingly at a low valuation, and I held that until we sold it to Booking. But because I felt the network effect was there and it was going to keep compounding and that kind of thing. And look, clearly, what Bezos has done or Zuckerberg, like if you think you're sitting on one of those and you have to ask yourself.
Well, those are 2.
Yeah, well, I know. But if you think you are, maybe the Collison brothers are another one. If it's going to play out the way those did, you're going to want to hold it.
Google it.
But they're very rare.